Welcome to the Principles Experience. This channel is designed to give you financial content in the areas of business, finance, and investing, while bringing you stories of the mindset of entrepreneurs and their tips on building the business. Sit back and learn on how you can develop your financial wisdom and create a blueprint for financial freedom. What's going on, world? Welcome to another edition of the Principles Experience. My name is Kevin Jenkins, and this is the 17th episode. And today I want to talk all about fundamental analysis and why it's important when you are investing. Now, when you are making an investment decision on a company, or even an index or a mutual fund or even options, it's very important to do the research. Now, episode 3, I did mention the importance of evaluating financial statements, looking at the management team of companies before you make a decision. But I didn't go over specifically my process and how I use fundamental analysis. And that's what this episode is all about. And I just wanted to say before I start, I'm grateful that you all are listening and watching this content, and continue to share, like, and subscribe, and continue to spread the message. Now, the reason why fundamental analysis is important because it allows you to understand how a company operates, if they are profitable, if they have a lot of debt, or even if the company aligns with your values or your interests. Now, in this episode, I'm going to show you how I use fundamental analysis when investing in companies. We're going to go over a couple examples. I have a couple companies that I'm going to share my screen with, and I'm going to allow you to be able to go over the fundamental analysis process with me. Now, if you haven't heard episode 3, I would recommend listening to that episode because it really gives you an understanding of how to structure your investment portfolio. So let's go ahead and get started. So what exactly is fundamental analysis? Now, it's usually when you're looking at the outlook of the industry. So you're looking at the specific sector, you're looking at what the industry is doing as a whole. So you may look at the market capitalization of what the company has done since it's been in existence. Also, you're looking at the management of a company. So you're looking at who the CEO is. You're looking at his background, his or her background. You're looking at specifically maybe the chief technology officer or the chief financial officer. Looking at the management team is important because you're understanding the people that are running the company. And I know when I'm investing in a company, I do go to the investor relations page of any stock that I'm looking at, any mutual index fund. All of their websites have an investor relations page, and you have access to looking at the financial statements. You can look at the management team. A lot of times companies will even create presentations where you can specifically learn more about the company. Now, also with fundamental analysis, you're looking at the product lines of the company. You're also looking at the anticipated introduction of new products happening in the future. So I know, like for Apple, they're releasing another Apple Watch coming here soon in the fall. And then also they are releasing just more services like Apple Plus, Apple One, I believe it's called, where you just have more access to using their platforms. And, you know, Apple is a great company that they're very great at branding, and everything what they're doing with the Apple Watch, with the iPads, really with the wearable technology, they're really expanding their company and growing it at a rapid level. Now, also with fundamental analysis, you're looking at the market share of the company as well, kind of like what I briefly mentioned with the market capitalization. Now, these are mostly the fundamental factors that I just went over, but there also is another aspect, which is the financial statements. Now, usually with financial statements, you're reviewing the balance sheet, you're looking at the income statement and the statement of changes to retained earnings, which allows you to be able to see the company's financial results. Now, under the Investment Company Act of 1940, the companies or funds that you invest in are obligated to send financial statements to shareholders semi-annually, which include the income statement for the fund, a balance sheet and a listing of all the holdings in a portfolio if it's a mutual or index fund. Now, as a shareholder, you have the right to receive annual reports and semi-annual reports. So definitely make sure if you are invested in companies, make sure that you're receiving those financial reports and you are getting those semi and annual reports so you can take the time to do fundamental analysis and being able to go through this process of evaluating a company before making an investment decision. Now, when looking at the income statement, the balance sheet, and the listing of the holdings in the portfolio, we're going to go over that shortly. Like I said, I have a few examples and we're going to break it down. Now, before I do that, I wanted to briefly talk about the statement of changes to retained earnings. We're not going to go in depth into that in this episode, but I will at another time. But just so you have an understanding, usually when you see retained earnings on a balance sheet, this is simply the money the company has saved for future expenses. Most of the time, when a company has to pay dividends to their shareholders, they would take it out of their retained earnings, or companies would just use retained earnings as simply a savings or an emergency fund in case anything happens with the business. They have money that they can pull from that they can be able to take care of their expenses within their company. So for the first example, we're going to analyze the balance sheet and the income statement for Stryker Corporation. The ticker is SYK. I know in episode 13, I did briefly talk about Stryker when I talked about the healthcare industry and how it's a sector that has grown substantially over the last 2 years, 10 years. And as you all, probably know, or some of you may know, Stryker, they're a leading medical technology company, and they help provide a lot of medical devices for hospitals. They provide medical devices for dentists. They provide a lot of different things within that area. So it's definitely a company to look at, and they are specifically in the healthcare equipment and supplies industry. And this industry has an average market share of 19.41 billion. And Stryker, as of September of 2020, they have a market share of 79.07 billion. So that just goes to show you the market share that Stryker has within this industry, and it's definitely a leading company when it comes to medical devices. So I definitely wanted to emphasize that the healthcare industry is only going to grow in the future. So this is a specific stock that I would pay attention to. So I'm going to go ahead and I'm going to share my screen with you guys, and we're going to kind of go through a breakdown. Now, I use my investing through Fidelity. Whatever yours may be specifically, whether it's TD Ameritrade, E-Trade, all of them give you access to their websites where you're able to look at financial statements of the company. You're able to also look at key statistics, and you're able to look at different information that will give you access to using fundamental analysis. So let's go ahead and let's break down Stryker Corporation. So as you can see from the balance sheet, if you look at, and this is for the year ending in December 31st of 2019. So this isn't 2020. These are the financial statements when it comes to the end of 2019. And all these numbers are in millions of US dollars. So even if it looks like thousands, just keep in mind that this is all in millions of dollars. So when it comes to the balance sheet, I just want to explain what current assets are and the other indicators that you see under this non-current assets. I'm going to explain liabilities and stockholders' equity, and which also is also known as shareholders' equity. But when it comes to the balance sheet, it shows you the company's assets and liabilities for a specific point in time, or you can even look at previous years as well. So if you look here, it tracks it from the last 5 years, so all the way to 2015. You can see the financials for Stryker Corporation. And when you look at the balance sheet, the formula will always be assets minus liabilities equals shareholders' equity. So if you see how this assets total, and then if you look at the liabilities and shareholders' equity, that number is always going to be the same. So usually when you see that, you know that the financial statement is balanced. Whenever that number is off, which you never will usually see that, on a brokerage website, but if that number is off, that tends to be a red flag. It's not balanced as far as the financial statements. Now, when you are looking at current assets and current liabilities, as you can see with looking at this balance sheet, with current assets and current liabilities, keep in mind that these have to be due within a year. So the current assets have to be due within 1 year. The current liabilities have to be due within 1 year. And the current section is important because it allows you to see the liquidity of the company. It also allows you to determine if the company has enough current funds to meet its bills, as well as any excess funds for other business purposes. Now, as you can see with the first indicator, we have cash and short-term investments. The total for the year of 2019 was $4,425,000. Now, with cash and short-term investments, these are usually highly liquid, and they can be turned into cash in 3 business days or less. Accounts receivable, which you can see with the next one, is invoices that are sent by the company for payments that they expect to receive within 30 days. Inventory, which is the next indicator, is simply the goods in the company that have not been sold. So usually just inventories is, the goods that you just, the goods that you have within your company that haven't been sold yet. Now, when it comes to non-current assets, just so you have an idea of property, plant, equipment, and tangible assets, non-current assets are long-term investments for which the full value would not be realized within the accounting period. So, for example, with intangible assets, that's usually trademarks or patents or even goodwill. And, kind of like with non-current assets, they're not realized within the accounting period. So they may be used in the future, but they're not used in the current period. So that's why it's a non-current asset. Now, if we look at current liabilities, accounts payable, which is the second indicator, this shows that this is the amount that's owed to trade creditors of the company. And that's why you see the creditors right there. Now, with wages payable, it isn't shown on this balance sheet with Stryker, but wages payable is also usually on the balance sheet, and that is money that's owed to employees, so such as salaries. Now, for income taxes payable, which you see here, this is the tax amounts owed to federal, state, and city governments which haven't been paid. So, one way that you can measure liquidity of a company is you can look at what's called net working capital. And pretty much what net working capital is the current assets minus the current liabilities. So we can see here, if we look at, the current assets for the stock at the end of 2019, it shows here that it was 11,360,000. And then the current liabilities that we see here for the total ending in 2019, it was 4,400,000. So let's go ahead and let's do the net working capital formula. So as you can see, we're going to go ahead, we're going to break this down. So I'm going to put net working capital. And this is a great liquidity ratio that you can use to really get an understanding of how the company is utilizing their funds and seeing if they have enough money to be able to cover their bills upcoming in the future. And it also allows you to be able to see if they have any excess funds that they can use in the future as well, after all of their, current bills have been taken care of. So net working capital equals current assets minus current liabilities. So we said the current asset for the year of 2019 for Stryker was 11,360,000. 390,000, and I just want to clarify on that. Oh, 360. My mistake. 360,000. And then we're going to minus that from the current liabilities, which is the 4,400,000. And this total is going to give you, and I'm going to pull my calculator up just so we can do this together. So let's say 11,360,000 minus 4,400,000 is going to be 6,960,000. So this is going to be the net working capital for Stryker for the year ending in 2019. 960,000. And this is in millions. So this is the net working capital formula, and this is a great liquidity formula that you can use, when investing. And it's a great formula because, like I said, it breaks down a lot of that information when you need to see how they're really using their capital when they're investing in their particular expenses within their company. Now, another formula that I did want to go over is the current ratio. Now, current ratio is another liquidity formula as well. And with the current ratio, the formula for is current assets divided by current liabilities. So this is another ratio that you can use to measure liquidity. And it's just another way to see if a company has enough assets to be able to cover their current liabilities. So let's go ahead and we're going to do another. So we're going to go ahead and delete this, and we're going to go ahead and we're going to move on to the next one. So this is going to be the current ratio formula, and this equals current assets divided by current liabilities. Oops. And yeah, these are very good ratios to use when you are measuring liquidity. So when we look at the current assets, well, we're basically just taking the same numbers and we're simply dividing them. So we're still taking that same 11,360,000 divided by divided by 4. I don't know why it's doing it like this. So I'm just gonna have to do it like this. I'm just gonna say divide the 4,400,000. And this equals, and I'm gonna pull the calculator back up and we're gonna do this together. So we're taking that 11 million, dividing it. And as you can see here, it simply shows 2.58. And I just wanna double check on that, make sure that my numbers are correct. So 2.58. So 2.58, and I'm going to put this in here just so you can see it. 2.58. So this is 2.58. So Stryker has 2.58 times the current assets needed to pay its current liabilities. And I just want to write it out so you all can have an idea. And if you do have a pen and paper at home, you can definitely write this information down. I am going to delete it as I put in the next ratio. So I would definitely write it down just so you have an idea of some ratios that you can use for companies that you are invested in. So they have 2.58 times the current assets needed to pay its current liabilities. So as you can see with Stryker Corporation, they have more than enough funds to be able to take care of their current liabilities, to pay their bills, and they still have money and access to cover any future expenses that may come along in the future. Now, I want us to break down liabilities and shareholders' equity. Now, when it comes to long-term liabilities and stockholders' equity, these are the sources of the capital for the company. So the company usually raises funds for its operations by selling bonds, preferred stock, or even common stock. And with long-term debt, it's a funded debt, and it's debt that must be repaid in more than a year. So Stryker, they have a long-term debt total of 10,532,000, and their total shareholders' equity is 12,807,000. Now we're going to go ahead and we're going to do another. It's not a formula, but it's so you can be able to see what the total capitalization is for Stryker. And you can find this out by simply looking at the long-term debt and the shareholders' equity. So we said that the long-term debt equals 10 million. Trying to minimize that. 10,532,000. And then the shareholders' equity equals 12,807,000, and this is in millions. So when we look at the total capitalization of Stryker, we're going to find out what their total capitalization is as a company. So let me just clarify those numbers. Long-term debt, 10 million. And then shareholders' equity, 12,807,000. So, okay, we're going to pull the calculator up again. And we're going to simply add these two numbers to figure out what the total capitalization is for Stryker Corporation. So we're taking that 10,532,000. We're adding that to the 12. And as you can see here, we get 23,339,000. So 23,339,000. And that's in millions, like I said. And I just want to clarify on that. So Stryker Corporation, they have a total capitalization of 23,339,000. So that's really good. You know, it's really good. Their market capitalization is a lot within the industry. And it just kind of gives you an insight on, you know, when you're trying to evaluate the total capitalization of a company. So now we're going to move forward to income statement. One second. One second. I'm just going to log in, and we're going to go ahead and we're going to go over the income statement for Stryker. Okay, so I'm going to share my screen with you guys again. Okay, so we have the income statement here. Now, as you can see here, you have the net income. You can see the cost of goods sold. For the last 5 years, you see the gross profit, which also gives you, you know, more information. You have the pre-tax income. You have the total net income of what was lost. Now, when it comes to the income statement, this simply is showing you all of the revenues and expenses for the year, for the given year. And one way that you can look at the profitability of Stryker is you can look at the net profit ratio. And when you use the net profit ratio, you're simply taking the net income after tax. So the net income after tax is going to be down here, which is this 2,083,000. You're taking that amount, and then you're also going to take the net sales, which the net sales you see was 14,1,884,000. You're simply taking these numbers and you're just going to divide it. Dividing it is going to allow you to be able to get a certain percentage to have a better understanding of the profitability of Striker. So let's go ahead and we're going to go over it. We're going to go over the net profit ratio. So we're going to go back over to this and we're going to do the net profit ratio. Net profit ratio, and we said that it's the net income after tax divided by the net sales. Oops, some difficulties here. Okay, so let's go ahead and look at the net income after tax again. Net income after tax is the 2,083,000. So we're gonna say 2,083,000, and then we're going to divide this by the net sales, which, as you can see from the net sales of ending in 2019 was 14 million, 18,804,000. So let's go ahead. This is 14 million. $884. And when you get the total is going to be 13%. And I'm going to show it on a calculator just so you guys can get an understanding and see it visually. So you're going to do that, and you're going to divide it by the 14,884,000. And as you can see here, so you're going to round up, so it's going to be 13%. You see the 13.99? So it's going to be 13%. So simply, Striker, they earn a net profit of 13% after tax on the sales. So I wanted to go over some key statistics with Striker. So this kind of gives you a foundation of doing some fundamental analysis. And also when it comes to the statement of cash flows, pretty much all this it's allowing you to be able to see the operating activities. So you're able to see the income before extraordinary items, the adjustments to the net income. You're able to see the investing activities, the capital expenditures. You're able to look at the financing activities. So looking at what they spent with the common and preferred stock, their cash dividends, what they paid out. All of this is great fundamental analysis to be able to make a sound financial decision when you're investing in the company. Now, we're going to go over to the key statistics. I usually like looking at the key statistics when I'm evaluating companies because I'm able to look at the market cap. As you can see here, the healthcare equipment and supplies average is 19.41 billion. With Striker, you can see they own a lot more than what the average is, which is 79.07 billion. And this is for 2020. So I know I gave you guys a different number when I said the market capitalization for the end of 2019, but that just goes to show you that it has grown from almost, 25 million all the way to 25 billion all the way to 79 billion. That just goes to show you the growth of Striker. And then you have the price earnings, which kind of just shows you the earnings for all of the shares. You have the earnings per share, which really is showing you the company's profits, and they're dividing that by the outstanding shares of the common stock. So you can see the earnings per share growth in the last 5 years, 32.54%. I love seeing this because this is really showing me the company has profit and they're a profitable company. They have grown over the years, and it's a lot higher than what the average is with the 10.19%. Then you also have the profit margins. And I like to look at, gross margins and operating margins, because that allows you, with operating margins, you're able to look at what the net sales were minus the cost of goods sold. That's simply all a profit margin is. You're just taking the net sales and you're minusing it by the cost of goods sold. And as you can see from their operating margins, it's 20.14%. Most recent quarter, 8.50%, gross margin 60.27%, and it's all higher than the averages that you see. So this is a great quality company. It's a company that I have on my watch list. As you can see here, the debts as well and the operating metrics. But it's a great company, and it's one to keep your eyes on when you're looking at the healthcare and the medical device industry. Now, the next that we're going to go over is a fund that I'm invested in, and this is the Vanguard Index Fund. And the Vanguard Index Fund, it is, the ticker, as you can see here, is VTI, and this is going to show you the listing of the holdings in the portfolio. So as you can see here, we have Apple, Microsoft, Amazon, Facebook. You can see many others, and it even breaks down a percentage of what they have within the fund. You also see the regional exposure. So you see it's a lot in North America, the country exposure with the United States, which ties in to North America, a little bit with the United Kingdom. And then I really like looking at the sector exposure, because I really get to see how this fund is being spread into different sectors. So as you can see here, information technology, 26.61%, healthcare, 14.46%, consumer discretionary, you see that number, 12.42%. And this is really good because as I explained in episode 13, that the technology sector is one of the most growing sectors out of all the sectors in the last 10 years. So this fund is heavily invested in the tech sector, in the healthcare, in consumer discretionary. You can see it has some large market capitalization. It's a blend with a lot of the large cap funds. And then the industry exposure is nice too, because you get to see how it breaks down in each industry. So you have the banks, you have the healthcare equipment and supplies, which is 3.75%. We briefly mentioned healthcare equipment and supplies. And with the Vanguard Index Fund, is passively managed. So you're not going to have a fund manager with this fund. It's self-directed. So it's a fund that I contribute to every single month. And, it includes large, mid, small, and micro cap stocks. So that's why it's called a blended fund. Now, with the index fund, it doesn't have a management team or product lines, because it's not one specific stock. It's a bundle of stocks in this fund. So if you needed to look at that information, you would simply look at the companies that are each individually in this fund to be able to look at that specific information. And a lot of times with an index fund, kind of how we looked at with Stryker, when it showed here the income statement and with the balance sheet, how you can see the current assets and the liabilities. If you look at the Vanguard Index Fund, which this is their financial statements, it doesn't break it down like that, because it's showing you an overview of all of the sectors and the stocks. So as you can see here, it breaks down, basic materials, what the market value, what the percentage of net assets are. You can see how it has all of the individual stocks that are in that specific sector. You have consumer services here. Shows you the numbers as well. You have financials. So it looks a lot different with an index or a mutual fund, but you still can evaluate and you can do the research and you can still look at the companies that you are really have an interest in, and you can run those ratios individually with the stocks. But yeah, it's a great fund. This Vanguard Index Fund is one that I'm personally invested in, and it has a lot of great diversity with it, and it's a fund that has grown substantially within this last year. So it's a fund that I would definitely pay a lot of attention to, and it's one that I feel that you can have great success with when it comes to your investment strategy. And the last thing that I just wanted to emphasize to you all, that kind of what we went over today is simply just fundamental analysis. And this is the number one principle when it comes to investing. You want to make sure you do your research before you invest in a specific company, because if you don't, it's going to present a lot of frustration and headache, because you don't have an understanding of the direction of where the company is going to go. So kind of what we went over today, looking at the income statement, looking at the balance sheet, looking at the portfolio composition when you're looking at an index or a mutual fund. All of this is great, and it's going to give you great principles when you are investing in companies, and it's just going to allow you to make a more sound financial decision. So I want to tell you all, thank you so much for watching this video. If you could please like, subscribe, and share. Continue to spread this message along your family and friends. Continue to educate your family and friends. Let's continue to keep discussing financial literacy and how we can move towards financial freedom and creating the blueprint that's needed to get us there. So thank you so much for tuning in to another episode of the Principles Experience, and take care.